Have you ever seen someone skip a step when going upstairs? Instead of stepping on every stair, they jump two at a time. Later, if they come back down, they usually fill in the missed step. That's exactly the idea behind a fair value gap in trading. So, what is a fair value gap? In simple terms, it's a gap on the chart where price moves too quickly, leaving an imbalance between buyers and sellers. Let's break this down step by step. In a normal market, price moves smoothly because there is a balance. Buyers and sellers exchange orders and each candle overlaps a little with the one before. But sometimes big players enter with huge orders. Price shuts up or down so fast that it doesn't give the other side time to react. This leaves a small empty space between candles where no real trading happened. That empty step is what we call a fair value gap. Now, why does this actually matter? Because the market often comes back later to fill that gap. Just like water finds its level, price tends to return to those empty areas before continuing its journey. Let's use a real-life analogy. Imagine you're painting a wall in a rush and accidentally skip a small patch. The wall looks okay at first, but sooner or later you'll notice the missed spot and go back to cover it. That's how price treats fair value gaps. Unfinished business that often gets revisited. Here's how traders use it. When you spot a fair value gap below price in an uptrend, you expect the market might come back to that zone before continuing upwards. In a downtrend, the same logic applies in reverse. It's important to remember, not every gap gets filled right away. Some fill quickly, others take days, and a few never get filled at all. That's why traders don't blindly buy or sell just because they see a fair value gap. They combine it with other tools like support and resistance, trend lines, or order blocks. Here's a simple step-by-step way beginners can spot and use a fair value gap. Look for a strong candle, either bullish or bearish, that moves sharply. Check if there is space between the wicks of the candles before and after. That space is your fair value gap. Mark the area as a zone on your chart. Wait to see if price comes back to that zone. If the overall trend supports it, plan your trade entry near the gap with a stop loss just beyond it. Let's add a psychology angle to this. A fair value gap shows urgency. It means one side, buyers or sellers, was so aggressive that the other side couldn't even fight back at that moment. But the market is like a pendulum. The urgency cools down, and the imbalance often gets corrected. Another day analogy. Imagine a store on a Black Friday. Shoppers rush in and clear out the shelves so fast that some items never ever touch the display. Later, the store restocks to fill those empty spaces. The fair value gap is the shelf that needs restocking. Here is an example with numbers. Suppose GBP USD jumps from 1.2500 to 1.2600 in one candle, and the next candle starts at 1.2590. The space between 1.2500 and 1.2590 is a fair value gap. Later, price might return to 1.2550 before moving high again. Traders mark that gap as a potential entry zone. But here's the warning: don't trade every fair value gap as guaranteed money. Sometimes gaps get filled quickly, sometimes slowly, and sometimes never. That's why confirmation matters. Wait for a reaction in the zone, not just the existence of the gap. So to recap, a fair value gap is the empty step on the chart created when price moves too quickly. The market often comes back to fill that gap before continuing. Traders use fair value gaps as zones for possible entries, especially when they align with the overall trend. Always combine the fair value gap with other tools and wait for confirmation. In short, a fair value gap is like unfinished business in the market. Spotting these zones helps you see where price might revisit, giving you an extra edge in planning your trades.